Welcome, ladies and gentlemen, from me, Guy Monson, Chief Investment Officer of Saracen Partners, to our regular 6-minute strategy. This week I'm looking at Brexit, the cliff edge we'll likely see in October, and what this means for UK and global financial markets. Let's begin with the UK economy on the left, a brutal second quarter drawdown, an extraordinary minus 20%, exaggerated simply by the timing of lockdown. April, May was the worst in the UK. We went in late, we came out late. US down 9%, Euro area down 12%. We should, though, recapture quite a chunk of that. And certainly the early indicators from the Purchasing Managers' surveys, which look ahead for service industries and financial industries, a number above 50 indicates expansion, shows that we are reasserting growth. And actually, if anything, the UK numbers are slightly better than the global peer group. What does this mean for Brexit? Well, we had the 7th round of negotiations in London last week, and they weren't great. We're stuck on the same issues we were in June, fisheries and state aid. In fisheries, I think to an extent, Europe is guilty of having its cake and eating it, and wanting really to go back to pre-referendum fishing rights, even though the EU is now a separate party to the UK. On state aid, I think probably the UK government is not realistic. I think wanting access to the single market is going to mean obeying some or a great deal of its underlying rules on things like state aid. Other issues: Barnier's notice assistance rights, road haulage, social security coordination. Frost, on the other side, more focused on process, and he said it's really difficult to unfreeze the talks because of this parallelism, this need to pre-accept the position on fisheries and state aid, which is enforced by the EU. So the 8th and final round begins on the 7th of September, next week. What we pray for and what we hope for is that we get some parallel concessions at the beginning of those talks, which unlock progress. Looking at the currency markets on the left, they don't seem overly concerned yet. The US dollar weakness has allowed the pound to benefit along with other currencies, and we're interested in this same channel against the euro that we sat since the referendum in 2016. So what are we expecting? Well, I'm afraid we're with consensus. We think a partial thin deal is the likely outcome, a deal with no tariffs, no quotas, and minimal non-tariff restrictions. But many non-trade areas where they have found common ground probably won't be integrated into a deal in such a short time frame. So we expect negotiations to continue on subparts of the deal well after 2020. The risk to all of this is simply the brutal timetable. This is the 2020 calendar as the EU sees it, and you can see that in the end of September we're really meant to have concluded the EU-UK negotiating rounds, and we simply haven't got there yet. Looking at my own timetable here, the 24th, 25th of September EU Council meeting doesn't even have Brexit on the agenda. That'll be pushed forward to the 15th, 16th of October, and expect October really to be high noon. I think there's going to need to be political intervention, particularly from Boris Johnson and European leaders. The absolute stop date is probably the 14th of December, when the European Parliament has its final meeting, which could approve the deal. Remember, we need qualified majority of states and EU Parliament. But that means getting things concluded by late October, early November at latest. So October will be Brexit high noon. So what does this mean for UK financial assets? Well, both the cloud of Brexit and the structure of the UK market has meant really some extraordinary underperformance in 2020 and really since the referendum. For the year to date, the UK down 24%, world equities up almost 4% in sterling. One of the biggest divergences I've ever seen in a G7 member stock market relative to the world index. Looked at right from June 16, when the referendum was, you can see that similar enormous divergence. And it's not really the effect of small caps versus large caps, it's really the growth value story, which has really characterised global equity performance across the world, but particularly so in the UK, because our index doesn't have a robust growth sector. It doesn't have many obvious post-COVID winners, if you like. Ocado, as an example, would just be one single name. Banks, oils and commodities make up more than 40% of the index, and this has been an obvious drag. So where do we go from here? Well, the Bank of America Merrill Lynch Fund Manager Survey, the biggest in the world, asked fund managers the assets they like and they dislike. And I'm afraid For many months now in a row, the UK has been the least liked asset. In the August survey, liked even less than energy stocks. That has a positive as well as a negative. The negative is mean that international fund flows have been negative into the UK market month on month, almost without exception since Brexit. If there was to be a turn, if there was to be a signature applied, you could see those fund flows come back remarkably aggressively, a sort of champagne cork moment. So what are we doing? Well, one, we're a global house, so this hasn't really impacted our equity selection. But we do today see value in the UK and in some of the newer growth stocks among mid and small caps. Secondly, we have currency futures in to protect against a sharp rally in sterling if there is a deal. That's been useful as the dollar has fallen. And finally, we are interested in sectors of the UK market which would provide robust post-COVID dividend flows, particularly the pharmaceuticals, particularly some of the new growth areas, and particularly areas that could be long-term beneficiaries, like some of the retailing and house building side. So I hope that's helpful. Hope it puts Brexit in a little perspective and helps you plan your asset strategy. Thank you.